Good evening. Welcome to Markets Today. I'm Lata Venkatesh. With me is Surabhi Upadhyay. Finally, the domestic financial problems of the China markets started hitting other asset classes and markets. Commodities crashed overnight, and today the Indian equity markets, along with several other Asian markets, took a rather deep knock. The Sensex and the Nifty lost nearly 1.8% apiece. The mid-caps, 1.25%, but still, if you looked at the advanced declines ratio, there were 3 stocks which fell to 1 stock which gained. So clearly, Indian markets have more than just Greece to worry about at this point in time. Hi, Surabhi.
Hi, Lata. Yes, a challenging day for our markets, and we will be getting you lots of global opinion on the show today. But first, let's get you the headlines. Tremors from China reached the Dalal Street. Benchmark indices fall 1.75%, with the Nifty slipping below 8,400. The Sensex tumbles nearly 500 points. Commodity and banking stocks feel the heat.
The CNX Metals Index tumbles 4% as the rout in the Chinese market raises concern over commodities demand. Vedanta, Tata Steel and Hindalco tumble between 5 and 8%. Kane India, Reliance and ONGC end weak as crude oil prices remain subdued.
The mid-cap index suffers a smaller blow compared to the blue chips, but still down over 1%. Infrastructure and realty stocks like JP Associates, HDIL and HCC see selling pressure. Deepak Fertilizers, however, bucks the trend, gaining 7% after the Delhi High Court orders the government to resume gas supply to the company's plant.
The Bank Nifty falls 1.8%, but Yes Bank falls over 7% after UBS downgraded the stock to a sell, saying loan approvals to stressed companies have increased threefold in the last 3 years. The bank's management told us the UBS report is exaggerated and exposure to stressed companies isn't high. Well, those were some of the headlines that dominated the market's thinking. Here are the experts that we have lined up on the show for you. It's an impressive array, I must say. Ruchir Sharma of Morgan Stanley will tell us exactly what's going wrong with the Chinese markets and the economy. Andrew Holland of Ambit Capital tells us how the headwinds from China will impact the Indian market. Victor Schwetz of Macquarie also joins in with his take on the global developments and its impact on India. We'll also get you the management of Yes Bank to talk about the UBS downgrade. All that coming your way in the next half hour.
All right, but before we get you all that very important global opinion, let's tell you what exactly transpired. News from China and Greece proved to be a heady cocktail for our markets. After showing some resilience in early trade, stocks fell in tandem with global equities. Anuj Singhal is now here to wrap up the day's market action. Anuj, tough session today.
Well, bad day on the last street today. The market ended at low point of the day. It opened gap down, and while there was an attempt to recover, that was sold into, and the market ended at the lowest point of the day, near abouts at 83.50. 49 out of 50 Nifty stocks ended in the red, and cash market volumes picked up on the selling side. So clearly there was a bit of panic on the street. Now, the options data is indicating that the market may well have made a peak around 8,500, 8,550, but the downside, the jury is still out. 8,200, 8,000, we don't know. A lot of stocks hit 52-week lows. The most prominent among them was Tata Motors, that hit a new 52-week low on Chinese concern. In fact, let's talk about some stocks. Tata Motors, HDFC, Infosys, these were some big contributors to the market fall. In terms of biggest losers, we had stocks like Vedanta, Yes Bank, Kane India, Tata Steel, Hindalco, so all the metal names were down. Mahindra & Mahindra was down, and in the mid-cap basket, a lot of high beta stocks were selling off. HDIL, JP Associates, prominent among them, and even some of the finance stocks like Bajaj Finance seeing a bit of a sell-off. So a bad day, an ugly day, I might add, and one that may well have changed the trend of this market. So from tomorrow onwards, this might well be a sell-on-rally market, but of course, we'll see the evidence of that over the next 3 or 4 days.
Yes, the jury perhaps is still out, Anuj, but the markets actually went from weakness to weakness. The first bout of weakness hit the metal stocks, which Anuj referred to. It was the Tata Steels, Vedantas and the Hindalcos which took the first hit, and then it went on to the other commodity stocks like Reliance and ONGC. But later on in the day, a bigger blow came even for the banking space, many of whom have lent to the steel companies, with steel prices crashing in China and therefore the landed prices in India. There was considerable problem with the metal companies, so the exposure to the metal companies brought the banks down. The chief among them was, of course, Yes Bank, which also suffered some negativity because of the UBS report. What happens next will much depend upon the sequence of events both India and abroad. Until now, the Chinese markets have been falling all the way from June 12th. That's about 20 trading days. But we didn't see that impact on the Indian markets this far because it was a domestic problem. It's quite possible that after the initial shakeout in commodities, the Chinese problem could be seen as not impacting the Chinese economy itself. Today we had a UBS report strongly arguing that neither Chinese consumption nor finance available to Chinese companies is going to be impacted because of the meltdown in the markets, and therefore it's not an economic problem, it's a financial markets problem. It's possible that there will be a floor to commodities, and that might put a floor to Indian equities as well, and thereafter probably the Indian story will once again become a domestic story, looking at the IIP numbers that come on Friday, the inflation numbers that come on Monday, the result season that starts day after tomorrow, and the monsoons. So enough domestic cues as well to probably give a floor or a ceiling to Indian markets.
Well, that's all that's happening in our neighborhood and extremely difficult for the market to deal with. Let's give you some insight on the story that's actually playing out in China. The Shanghai Composite plunged another 6% today as investors are not convinced with the emergency measures announced by the government. The stock market has been virtually shut down, with trading halted in nearly 50% of the stocks. It has been a roller coaster ride for China over the last few months. In fact, just take a look at the market movement. The Shanghai Composite rose 150% in the last 12 months. It has fallen over 30% in the last 3 weeks and 12% in just the last 1 week alone. And the crash sent investors running for cover across Asia today. Hong Kong was the worst hit. Even the Japanese Nikkei and the South Korean Kospi also saw some deep cuts. Now we have Richard Sharma, head of emerging markets at Morgan Stanley, talking about what he believes would be the end to the state-sponsored rally.
If you look at the entire up move which has happened in this market over the past 12 months, it had absolutely no fundamental basis. And we have all lived through many bubbles in the past, and this bubble in China meets all the checklists of a classic mania and a bubble. In fact, in some ways, it's the most extreme bubble I have seen in the last 20 or 30 years, because there was no fundamental basis for this massive rally to take place, given how weak the Chinese economy is, and given the amount of margin debt which has been accumulated in such a short span of time. In fact, today, the amount of margin debt in the Chinese stock market is higher than any market in history. If the economy can grow at 5 to 7% over the next couple of years, there will always be some opportunities. It's a large enough market. But the entire point here is that given the amount of debt that China has accumulated, the fact that it can grow at anywhere close to those rates is now being seriously questioned. And I think that the valuations also matter, that outside a few large cap stocks in China, the entire market is trading at extremely high valuations, and those valuations need to correct a lot more before they really become a buying opportunity.
Right. The Chinese government and the People's Bank of China are scrambling to stop the stock market rout by giving aid to finance companies. But so far, none of their measures have worked. Eunice Yoon of CNBC reports from Beijing that investors are fast losing faith in the government's policies.
Well, there's a lot of panic right now in the market, a lot of fear and anger. We went down to a brokerage earlier today, and there was a lot of hostility, a lot of retail investors who are scared about the money that they've lost, and most of that anger has been directed at the government. A lot of people have been saying that they have a loss of faith in the government's policies because, as you had said, they haven't really been holding up. The investors said that they are definitely not convinced, and when you talk about these investors, a lot of them are new, inexperienced investors. The way that the Chinese markets have been for quite some time is that traditionally equities hasn't really been seen as a very reliable investment. Most people here invest in property, or they save all of their money in the bank. And so we've seen over the past several months many investors jumping in and borrowing a lot of money for the first time. So as the market has been falling, we've seen more panic setting in. Investors worried that they have to cover a lot of debt, and that's why we're seeing exaggerated movements in this market. It's also the reason why a lot of the government authorities have been jumping in guns blazing to try to save the market. There was several moves over the past several days. The recent moves is the central bank came in with even more liquidity assistance today. Also, the government authorities called on the state-owned enterprises not to sell any of their stocks. Other companies have said that they're going to do their patriotic duty by buying up their own shares. Another big movement was the very unprecedented, at least in Chinese stock market history, of a massive trading halt. We now have more than half of all the listed companies in China have asked to have their shares suspended. So the purpose of this was to really protect a lot of these companies from the falling prices and the volatility, but it's actually having the opposite effect on sentiment. A lot of retail investors are seeing this as a very negative sign. They're worried about their ability to be able to sell or buy these stocks, and some of them are just saying that they're willing to sell out a lot of other shares because if they can't sell these stocks that are locked up, they might as well sell the ones that currently are available to them for trade. And that's putting a lot of excess pressure right now on the markets.
Okay, that was Eunice reporting on what we saw in the market today and really what's going on. Well, global commodity prices have been hitting multi-year lows. So be it copper or nickel or aluminum, the situation in China and Greece has taken away all the sheen. Nigel D'Souza is now standing by to take us through what this means for metal stocks in India. Nigel, not a very pretty picture.
Well, metal stocks were under pressure in today's trading session on the back of the sharp decline that we saw in global commodities. Let's start off with aluminum. That stock, in fact, went to multi-year lows, and because of that, we did see stocks like Hindalco, Vedanta Limited, as well as Nalco. All of them were under pressure. The premium on aluminum as well has now fallen from around $300 per ton all the way to around $150 per ton. Copper as well, that stock in fact is trading at fresh 6-year lows. So on the back of that, we did see a few stocks that got impacted. Hindalco as well as Vedanta Limited, they moved more on the TCRC margins. That's the treatment and refining margins on copper. Nonetheless, copper fell down. We did see that, in fact, traders went ahead and shorted both those two stocks. Hindustan Copper as well was under pressure in today's trade. Zinc has been a relative outperformer, but that one as well did visit near 18-month lows. So we did see stocks like Hindustan Zinc under pressure. Vedanta Limited got impacted yet again because it holds close to around 65% stake in Hindustan Zinc. Iron ore prices as well have corrected from around $60 per ton to around $50 per ton in the last couple of weeks. NMDC, and yet again, Vedanta has a small exposure to iron ore. Both those two stocks were under pressure. You'll say iron ore prices are falling. Maybe steel stocks will gain. But that didn't happen in today's trading session because the fall in steel has been far more than iron ore. That's why we see stocks like Tata Steel, SAIL, all of them were under pressure. And finally, nickel was down close to around 10% overnight. So that's a raw material for stainless steel products. So JSL Stainless, in fact, was in focus today. Maybe there'll be margin expansion, but today it was just sell on metals. So all those stocks, in fact, were struggling in trade.
Thanks a lot for that, Nigel. A Chinese contagion is already visible across other emerging markets, but does that mean foreign equities will flow into India? Here's what experts had to say earlier today.
We downgraded India from a significant overweight to a slight overweight. I actually will tend to agree that I think India getting to the stage that one can actually put more money into India rather than less. I still think earnings per share estimates are too high. I still think multiples are too high. And if deflationary climate gets stronger and the capital flows get tighter, I think India will have a problem, but maybe we're approaching the time when we can put more money into India.
We've been underweight for a couple of months now, and the story was really that there would be disappointment on the interest rate front and potential slowdown in growth as well. And what we've seen is that some of that is now playing out. Earnings growth is being revised downwards in India by about, say, 10% over the last 2 months or so. So that's taking place now. Valuations have, of course, come off a little bit as well. So on the margin, that's still the case. But I think there's still risk that maybe interest rates won't go down in India.
All right, from China to Europe, Greek Prime Minister Alexis Tsipras has made an impassioned plea to the European Parliament today to try and work out a solution. This comes just hours after Eurozone leaders issued a strongly worded warning to the Greek administration, saying it had time till Sunday to draw up a new proposal which could be agreeable to all its lenders. Tsipras promised to come up with a concrete proposal in 2 days.
In the next 2 or 3 days, we have undertaken to bring forward concrete proposals in detail, and I'm confident that in the next few days we will be able to meet the obligations of this crucial time in the best interests of Greece and also for the Eurozone. And can I say this is not just the economic, it's also in the best interest geopolitically of the European Union. And let me be crystal clear in this area. The proposals by the Greek government for the funding of its obligations and for the restructuring of its debt are not designed to provide an extra burden for European taxpayers.
All right, that was a very serious exchange between Greece, the Greek Prime Minister, and the European leaders. We'll, of course, hear more of this in the days to come. Time for a break on that note, but coming up, Sudarshan Sukari is joining us to give us an idea how the stocks may move depending on the charts. We'll also tell you about other stocks that were in the news today.